if you see the market over the last 2 weeks or so, when the corporate tax rate comes up, market responded very positively, then it sold off again. But over the last few weeks, even bad news is now factored in and the stocks are going up. So I think there is some suggestion that this long, painful 2-year strategy that we had where the market was moving sideways is over. And the index is right back at almost the highs. So I think the next Samvat will probably be much better for investors.
Manish, in your own words, markets always vote for rate of change. Focus on where the puck will move rather than the puck has moved. Do you think markets at the current juncture are pricing in all the bad news, all the headlines which has surrounded us? It's not an economic crisis, but demand drop is certainly a slowdown. Do you think a lot of bad news is in the price?
I do think so. And we've spoken about, economic cycles and market cycles in the past. And if you recall, phase one where there's a catalyst and something causes the markets to go up, people are skeptical. Then phase two is broader earnings come through. Phase three is when the P multiples expand. Phase four is the sharp correction. Phase five is the pullback and becomes very narrow. Phase six is the bust. And what we call phase zero is when everyone is throwing everything at the problem. So the RBI will be cutting rates, the government will be cutting tax rates. Everyone and his uncle will be calling up to say, what can I do? What can I make, make this better? I think we're at that period. So certainly this bottom formation period, I think when we will look back next year and the year after, we will see 2019 as a very, very firm foundation being laid for the economy. And very much like the 2001-2 period, where you got a catalyst in the form of privatization, you got a catalyst in the form of some important commodity or some important sector taking off. I think that's what one would look forward to in the forthcoming Samvat. So I'm completely on board that, as Ramesh said, I think markets now fed up of being pessimistic, kind of looking ahead to better times ahead.
Let me give you another example in that same period, 2001 to 4 period, which was after the tech bubble had burst. There are two things that stood out. First, the PSU sector performed dramatically. It was up 600% the next 3 years. But the market at that time was only about tech. We were all focused on tech. And then Infosys came out with a very bad set of numbers, and even veterans like me thought the market was over now because Infosys came out with bad numbers. And that was the day the bull market started, because it started looking at other sectors and finding great values in those sectors. Cement, exactly. And the market, moved on from there in the 2003 bull run that we had. So I think we are in a similar phase right now. I think the market is looking for new leadership. I think these great blue chip corporate governance stocks have held the market together as the flight to safety. But I think market will look for new stories, new action in the new year.
Manish, where will those new stories come from? Because time and again, if you dig out data for the last 10 years, it's the same set of names which have done well. Quarter after quarter, it's an HDFC Bank or a Bajaj Finance or a TCS. Do you think time has come to move beyond these A-listers, so-called?
So, well, I'm conscious that it's not appropriate for all retail investors to, do what we guys are up to. But like he rightly alluded, there is a segment which because of the structural shift in the economy, the market leaders and the governance kind of leaders are going to disproportionately gain. So whether it was in retail, whether it's in real estate, whether it's in banking, I think those people will keep doing extraordinarily well. And if the economy is, in my view, going to go inevitably from 3 trillion to 5-6 trillion, you cannot still have an HDFC Bank at a sub-$100 billion market cap. So in the context of where it can be, I think these will keep compounding. And despite so many cycles in the past 20 years, one learning I had was that some of these good companies keep compounding. So there's no reason to shift away from quality to something else. Having said that, on the other side of the market, there are companies which are intrinsically large caps, but have become mid caps by virtue of either the economic cycle or commodity prices and so on. We were just, for instance, speaking about a sector that I hate as well. But there is a 9 million ton steel company which is trading at a $1.5 billion market cap. Now, at some point in life, it has to go back to a 8 billion kind of valuation. And while there is a debt overhang today, over 2-3 years as you get this repaid, you will look back and say, hey, there was a 4-5 bagger sitting there and we missed it. So there are enough things to do in the market. And I sent you all some data also ahead of the interview, where I showed you like 500 or 600 reasonable quality companies are down by at least 67% from the all-time high, and it extends all the way to 80-90. Now, normally, if you're down 80-90%, it either means the company is going bust, or when it comes back roaring. And the same theme, like he mentioned, again, PSUs in aggregate are down between 65 to 80%. Now, if indeed they do put through the BPCL and the Concor, even BHEL I saw was down, I think 80% from its all-time high. A lot of these stocks will be 2-3x before we realize what happened, and no one would have participated because nobody owns them. So there is enough to do for investors. Outside the top 50 companies where everyone has gone and hidden out, I think individually there's enough situations over there.
Ramesh, is man late on actually sort of homeworking that list which has fallen 80-50 odd % from the top, but the market cap is still intact?
No, absolutely not. I think there's an old investment maxim that buying what is comfortable is really profitable.
Yeah.
And everyone has moved to this corporate governance, high quadrant returns.
Because you're so scared.
Yeah, so scared, you want to fly to safety. And I think that will reward, as you said, value if you're moving from unorganized to organized in that sector. But as the growth of those companies slow down, there will be a flight to other companies. And I think, as Manish said, the PSU sector offers that opportunity of leadership because the government wants to unlock value. So the first time, I think there's general consensus that BPCL and Container Corporation can be done. And if those actually get done over the next 6 months, I think there'll be a huge value unlock. It's like one domino falling. Suddenly everyone will start looking at all the other ones. You recall the tapes in 2000 when IBP got done and the excitement on the market that day when Arun Shourie announced it. I think we're entering perhaps the era of PSU disinvestment. For the first time, taxpayer money will now be productively allocated. I think it will have tremendous value in the stock market. So I agree with Manish that the marginal money that you want to put in the market, we're almost always well invested in the market. But the new money that you want to put in the market, I think you look for bargains in that sector. I think year on year, Samvat to Samvat, that offers the most promise to me.
Manish, let's look at the 4 pillars of the economy. Exports, shaky.
Absolutely.
Private sector or investment cycle is still shaking very badly. Consumption, slowdown, cyclical or temporary, we don't know. And then there is government action where there is some hope. This is the lay of the land. Which block do you think is going to move higher, which will ensure that the economy will heal and earnings will pick up?
See, like I said, each time when you start a cycle, there is a catalyst which comes out, and it's met with the disbelief that we are also experiencing now, that who's going to invest. We generally will have a broad brush approach to everything in India, and India is not about the averages, but about disaggregating. Even, for example, in the private sector, it's not like the cement people are not investing. And in fact, even in steel, while the IBC code is throwing up opportunities there, it's not like people are not investing there. And they are already at, I think, 130, 140 million tons of steel, and likely to be heading upwards. So metals, cement, oil and gas, there is enough of investment going in over there. Also remember, if we are a 65% services economy, the growth now comes from services rather than manufacturing or agriculture. And a lot of that investment actually happens in banks, it's happening in retail, it's happening in IT, it's transportation, logistics, and so on. So it's not like the investment cycle is dead. It's because, like I said, there's a clear demarcation between those who are dying and those who are thriving. And so the average is showing you like a 5% print. But those who are doing well are actually doing remarkably well. Including, for instance, in real estate, if I were to look at last year, a sector that nobody likes, I think Godrej and Prestige and people like that are up 60-70% even last year. Even in PSUs, which no one likes, just the whiff of a possibility in BPCL, I think the stock was up 80% last year.
It's the best performing stock on the Nifty.
There's enough opportunity everywhere.
And you saw that IPO, IRCTC, I mean,
as
that
well.
almost tripled from IPO price.
So my next question is a difficult one, Ramesh, and I'm going to ask you in both capacities, as chairman of DMart and as an investor. What do you make of this whole consumer slowdown? You have understanding and deep understanding of where the footfalls are, what Indians are consuming, where are they spending. Do you think the perception of slowdown is much greater than the actual reality?
Perhaps. I think the trick is you have to deliver value to the customers. I think India is such a large market. If you deliver value, they line up from morning. I mean, that's the experience we found. So you have to deliver value to the customers, even particularly in these hard times. So I think that, I realize, is the dividing line. Market is making a strong mistake in throwing the baby out with the bathwater because they're going into the corporate governance quadrant, and generally the consumer companies, the MNC companies, are the best reputed. People are ignoring the small caps and mid caps to their own peril because there's a lot of extremely well-run, good corporate governance standards in those companies. And while you can't call them on a sectoral pick, you can call them individually bottom up to pick those stocks. I think there's some astonishing bargains out there. And particularly also in the PSU, here's the point I'd like to make, which actually my son forced me to understand. He said, generally you people, meaning the stock market fraternity, is so bullish on Narendra Modi government, the BJP, which is fair enough. Generally they are bullish on the government. How can you not be bullish on the companies that he's running? If Mr. Modi came in with one point mandate is to change the corporate governance, to make sure there's less corruption, to make sure economic activity would proceed unimpeded. So now that he's the master of all the PSUs, how can he not be bullish on the public sector stocks?
But the last experience
He's the
was
CEO
bad.
of that cluster.
No, but the last experience, I mean, to both of you, was not a good one. Banks were recapitalized. A lot of attempts were made to reboot the PSUs, even in India 1. Unfortunately, nothing has transpired into what we thought, let's say, at beginning of 2014.
That's not true. I mean, you can look at the PSUs one big sector, and you can, come through all sorts of knots and struggles in there. If I mixed up all the Diwan housing and Manpasans in one sector, you would also see bad performance in the private sector. You need to cherry pick. These are different companies in different sectors. Some are in resources, some are like IRCTC and like e-commerce businesses. Some are like in defense and railways, which are protected monopoly businesses. So first, distinguish between the two. Some PSUs have done well over the last 20 years. Something like Bharat Electronics is a 200-bagger container corporation. Some of these have done brilliantly for investors. So cherry pick those sectors. But it's hard to see such large sectors going at such astonishing valuations, where they have order book visibility of 10 years, you have single-digit PEs, and yields of 5-6%. And the corporate tax cut will come straight to their bottom line and will pay it out as dividends. So I think investors need to refocus their attention. It's become very popular to say, I don't buy PSUs, I don't look at PSUs. But if you're a genuine value investors, and particularly if you have a government now determined to disinvest, I think you should be looking at it.
Manish, the other cluster is, the ones walking the walk of shame. Your DHFL, India Bulls, Yes Bank, add as many as you want. But on the other hand, what's interesting is that there are those conscious promoters who are taking that, last straw out of the hat and saying, I'll do whatever it takes to save my company. Perhaps part of the pain is over in Yes Bank. Who knows? Only time will tell. Of late, we've even seen a Bajaj consumer trying to deleverage balance sheet. We've seen attempts by the Z promoters as well. Is there any hunting opportunity within this pack where you feel that the worst is maybe behind? Or would you think don't be a cowboy?
No, I mean, again, it's not for the average investor to
Absolutely
do. And
not.
it is a space that I look at personally because where there is a forced seller, where there is a debt holder who's selling because he has to cover and he doesn't have a view on the underlying asset, you occasionally get real gems at fabulous prices. Unfortunately, we can't kind of go into that over here.
Sure.
But some of those players where there is forced selling, the promoter intent is correct, the businesses are still robust. It becomes like we all grew up reading Warren Buffett, for example, the famous salad oil scandal of American Express.
Yes.
You get opportunities like that once in a lifetime, and there are some like that. I just referred somewhere else to, for instance, media, and because I'm involved, I won't talk about Z. But in aggregate, if I add up Z, Sun, and Network 18, that's 50% of eyeballs of India. And in aggregate, the market cap of these three is less than $7 billion. And these are free cash generative businesses. And it's not like OTT is going to take over the world tomorrow. Even today, with the problems that Netflix will have, what happens to the OTT world once Disney comes in and so on, we'll see. Two, what is the buying power of the Indian consumer to pay for this, and will television completely die? Do they deserve to be 6 times EV EBITDA, for example? When we're buying chemical companies now at 14, 15 times, I think there's a bit of travesty happening over there. So, like he said rightly, there are nuggets. There are some sectors, there are some companies which you go in, and if you can understand what's really going on there, it's very interesting opportunity.